Hey Internet, it's RJ. Welcome back. Thanks for tuning into the show today. Now, today's episode, we're talking about two of my favorite things. We're talking about real estate and credit cards, specifically how you can use this, your house and all the money that you pay for your mortgage to actually help you achieve, those higher credit card sign-in bonuses, more points, more multipliers, free award nights, hotel, airline statuses, all the things related to credit card spend can be, kind of shortcutted through a potential way with your house. So that's what we're going to break down today. So, of course, if that sounds interesting to you, then go ahead, press the subscribe button, and let's get to work. Now, the one that you're probably most familiar with when it comes to, using cards and your house is really like giant remodel home renovation projects. If you're tearing out a kitchen, tearing out a bathroom, something like that, then yes, you're going to be able to have a ton of spend and use credit cards. But there's another thing as well, and it's, focused on money that you already have to spend. Remodels are nice and they always look awesome, but, for the most part, you don't have to do that, right? Sure, there are some cases, but you don't have to. And with the credit cards, we always want to focus on the spend that we have to do, right? Because you can't get around it, so you might as well get something for it. So we're going to do a little bit of Mortgage 101 here, but what we're talking about is part of your mortgage payment, you can technically kind of finesse and then pay with credit cards. But to get to that point, first, what is in a mortgage payment? Well, it's made up of a few different things normally. So let's take a look at this. So again, the abbreviation is PITI. What that stands for is principal, interest, taxes, and insurance. So principal, pretty simple. It's the money you owe. Your home, you took out a $200,000 loan. $200,000 is your principal. Interest is the financing cost of the loan. You borrowed $200,000. You're going to have to pay each month on that to borrow that money. That's going to be your interest. Taxes, those are property taxes. Government, local government, they want their cut all the time, so you have to pay property taxes. And there's homeowners insurance as well, making sure if anything bad happens, you are covered. Now, for the most part, those are pretty self-explanatory. But really the thing here to focus on is the homeowner's insurance and the taxes. Now, taxes, property taxes, no matter what, you're going to have to pay them even if you own your house free and clear. Government still wants their cut. Homeowner insurance, highly advisable that you keep homeowners insurance. Every so often we see like a storm comes through or something, people didn't have right homeowners insurance, and you're just kind of stuck, right? But those are the two that we're going to focus on because obviously you have to pay the principal and you have to pay the interest. But what happens here is when that mortgage payment, since it's composed of those four different factors, is the mortgage company actually, they say they're doing it to be nice, right? They collect all that on your behalf, right? That's why your mortgage payment is those four factors. And what they do is they put that into what's called an escrow account. So let's break down that a little bit, then we'll know enough to get into our credit card strategy here. So again, escrow account, very simple and to the point. It's an account set up by your lender to collect future taxes and insurance payments, so the lender will pay on your behalf. And basically, again, it is kind of a convenience to the borrower because you don't have to, budget for this, but, the lender's also protecting themselves so they know they have the money and they won't, miss out. So again, if we break these down, homeowners insurance, it's paid yearly. Again, it's going to be required by the lender. Now, you can self-select your own insurance provider, but if you do not have one while you're under, your loan terms, then they will impose an insurance company by the lender will basically make sure you have one. And property taxes, they're usually paid twice yearly, the summer and the fall. Then they're always required by local government, as we said. So that is kind of how it breaks down, right? Again, the rules, though, how do you end up like this? Because more often than not, the mortgage company isn't going to make it obvious that you don't have to escrow in certain cases, or you can pull your payments out of escrow and just go down to the principal and the interest, right? So really what happens here is that you take a look at where you're at in your mortgage process or your life of loan, right? So we put the rules on screen here. Again, escrow is required if you have less than 20% equity. So that would be called an 80% loan to value. So very simply put, it's a $100,000 loan. If you get it down to $80,000, I mean $20,000 of that is equity, then you do not need to have an escrow account. It's not required. So with that 20% down, again, you can remove the escrow, but you're going to have to request to remove the escrow. So, if you're buying an investment property or something like I did on an investment loan, it's 20% down, automatic. So at the start, you don't have to do the escrow. Now, they didn't really give me the option. You would have to speak up and voice that you don't want to do the escrow. But when you're usually buying a primary residence, then you're usually, at least my opinion is, I want to put down as little money as possible. So you're probably going to need the escrow. So there's that. That's the crash course in mortgage payments. So again, what happened with me was I was actually in my mortgage account. I was paying some escrow shortages. It's a whole nother deal. We don't need to get into it, but since it's an estimate, sometimes it comes up a little bit short. You owe money. So I was paying those, and I noticed that one house, of course, is an investment property. Again, it started out at 20% equity or 80% LTV, so I didn't have to have an escrow, but the other account said, hey, you're at 80.99, something like that. Basically, if you give us $1,400 more directly to the principal, then we could take off PMI, principal mortgage insurance, which for me in that house is only like $20, right? So not the biggest deal in the world. But that really got me thinking, well, if I, put in the $1,400 and actually requested to, have the escrows removed, that could free up a lot of, well, not free up, but create a lot of expenses that I would have to be responsible for anyways to pay with a credit card. So I know it's been a little bit of a journey to get to the credit card part, but now here's where it comes in. So we're going to look at both of these examples, house one, house two. I'm going to show you how it breaks down. We'll give you some strategies of why you might want to consider this. So when you take a look at it here, house number one, total payment about $1,700. It's broken down as taxes $594, insurance $165, PMI again $20. Yearly taxes $7,100. So now again, that's going to be paid twice a year, right? So it's not $7,000 all in one go, just twice a year. So if you take a look at the county, what the county is saying is, hey, if you wanted to pay your taxes with a credit card or debit card, it's a 2.8% processing fee, again, paid to the county. That comes out to about $200. The yearly insurance will be almost $2,000. Now, insurance, I have Progressive. They're just going to take a credit card. They're fine. They don't charge a processing fee. So really, what you're looking at this house, not only if you pay down the principal enough to get to 80%, you're saving $20 a month with PMI. Again, not the biggest deal in the world, for being honest, especially on rentals. But again, you're now, you're not creating any more expense because you were always responsible for this money. The difference is you were just prepaying and the lender was taking care of it for you, versus this way, now I have $2,000 a year in homeowners insurance basically, and we saw the tax number as well that I can, pay, and that can generate for credit card bonuses, things like that. So we'll talk about some strategies in a second, but we'll take a look at the other house as well to kind of show you the power of this again. Now this one, a little bit different. This is a much smaller house. We're talking about 1,000 square foot starter home, little bungalow style deal. Payment $874, taxes $310, insurance $121. Remember, this one was always 80% LTV at the start, so no PMI here. Yearly tax about $3,700. Again, this is the city of Dearborn. They charge 3%, getting a little greedy here, but that's fine. 3% processing pay with credit card or debit card. $111 is what that would come out to be. Again, you're still making those payments twice yearly. It's not $337 in one go. And the yearly insurance is all $1,450, right? So again, that's kind of a lot of expense right there. But again, the thing to drive home is you are always paying it. You're just simply prepaying the lender. They're holding on to your money and then making the payments for you. Now, in some states, escrow accounts like this require the lender to actually pay you interest. It's very few states, right? It's not really worth getting into, but you're foregoing spending and credit card points and things like that in turn for convenience, really, because you don't have to, it's already factored into your payment, so you don't have to force yourself to budget and think about these payments coming up, twice a year, once a year for insurance, right? So that's really the value. And again, the lender is protecting themselves because, they know they're covered, right? They have your money and they're keeping track of it, right? So really, what are your strategies? Why would you want to consider doing this and breaking the convenience? Well, here's a few. Again, sign-up bonuses, as you may have guessed, rewards nights, airline statuses, visa reloads with the in-cash, or an outside one here, lower your debt to income. We'll talk about all of these. Sign-up bonuses, pretty straightforward, right? That's a lot of spend, and even if you take a look at, the insurance or the taxes, 2.83%, sure, but you're getting such outsized value on a lot of these sign-up bonuses that it's a little bit of a haircut, but it still makes up for it, right? And bigger numbers like this, you're probably talking your business cards anyways that usually pay out more cash. So not too bad at all there. Now, if you had hotel cards that you spend a certain amount, you get an award night, like the Marriott cards, the newer ones. You have to spend $15,000 in a year to get a reward night. Well, this is also an easy way to do it. Now, of course, you'd have to figure out how you personally value that award night, but this could actually definitely help you get to that. It's very similar to how people pay taxes with their credit card to do this exact thing. Elite status or status on airlines, another obvious one here. Again, some of the higher end cards like the Delta Reserve, it helps you put enough spend on it. It helps you cut, some of those MQMs or I forget how they break it down, but it basically gives you one of the status bars through spend. So that could also be an option as well. Then how much do you value that status? Something like that. Then the other one here is the Visa Reload, MasterCard Reload cards you can buy at office supply stores. People love this strategy. It's not exactly a new one, but it is a fan favorite. You take your Chasing Cash card, and when gift cards go on sale at office supply stores, usually in denominations of like 200, they waive the activation fee. You can take the ink cash, buy those, 5% back as it's office supply stores, no activation fee. Even in the case of house number 2, a 3% processing fee to the county. Well, you're still playing a 2% spread, again, on money that you had to pay. And of course, you could go even further and say, well, I'm going to use these ultimate reward points through the travel portal or something, or transfer partners or something like that, which could easily bump you back into like a 4% spread or something like that, depending on how you value the points. Now, the last one here is not really credit card related, but it is finance related. I think it's worth talking about. So debt to income. Again, debt to income is a calculation that applies for, loans and mortgages specifically, when they're saying, hey, what's the amount you owe each month versus what you bring in? Pretty simple calculation. And so if you're me and like you want to add more property, right? It gets a little bit tougher, right? Because they want to see what they call capital reserves. Do you have enough money in reserve if one of these things goes bad and one of these houses isn't renting? It's a, fair requirement. But again, that's usually 6 months capital reserves, which is fine for one, but you're talking about 2, it's 6 months capital reserves for both of them. Gets a little bit tougher, but if you're lowering your mortgage payment by removing the escrow from it, then that number that gets reported to the mortgage company is going to be a lot less. Like in our case, the house number 1, you're talking about, $700 some odd dollars, something like that. I'll put the math on screen. So really it makes like, if I combine both of them, I pull them both out of escrow, it looks like I almost make like $1,300 less in liabilities each month, which would overall help the debt to income. Now, I can't confirm for sure that every single mortgage company or bank would not, say, okay, I know this is your base payment, and then would not, try to factor in homeowners insurance and taxes. It's entirely possible they could do that. It's not the hardest thing in the world, given that that's what they do for a living. However, more often than not, the bank just wants to take what's on record and then, so they can give out a bigger loan. So that is also another reason why I'm considered. That's actually how this idea started. I was like, well, I could actually lower the debt to income that I have, give myself in a little bit better standing, which becomes also more important as interest rates go up. It really does reduce your purchasing power. So to say, hey, look, $1,300 less in liabilities helps offset that, right? And then I started thinking more about the credit card application to this. So the last thing here to close on is stuff to be aware of. Now, again, the biggest thing here is, I would say, when to do this. This worked for me for house number 2, investment loan, so it was fine to begin with. But in house number 1, when I was in the account looking, they said give us $1,400 more dollars, which isn't bad, because you guys still have someone paying on that. So realistically, I would probably let them keep paying, through rental payments, and then probably before, springtime. February, March, I'd pull it out of escrow so I have plenty of time to, make the payment. Then you'll get that money back, when you cancel the escrow. You'll get that. They'll do an escrow analysis. You'll get that money back. But the point is, if this was like 90% LTV and I had to put tens of thousands of dollars into this, I wouldn't really do it just for the credit card spend. But because, I'd taken advantage of a refinance here a while back, it made sense now with it being so low and so little money I have to put into it. So I would keep track of that. Where you're at matters. I don't necessarily know that it's worth all these bonuses and whatnot to give them $10,000-$20,000 so you can hit some credit card spend. Probably not worth it. Then the other thing is really budgeting, right? That's the other big one. Again, taxes twice a year, homeowners insurance usually once a year. Sometimes it can be twice a year depending on how you're set up, but usually once a year. You're just gonna have to budget for those and keep those as top of mind, knowing when they're coming up. Those are the other big things, of course, picking your strategy, right? It's not like, taxes, income taxes. Something as simple as the double cash still gives you like a 0.02 spread. You're just going to want to make sure you have the right cards or the right strategy going into this to make it worth it. But overall, I think that was a pretty cool strategy for you homeowners out there or you real estate guys out there. Definitely one I'm going to be taking advantage of pretty soon. Here, just going to wait till we get to, we just made the last escrow payment, so I'll probably wait till a little sooner in the new year. But overall, I'm definitely going to incorporate this one. Hope it helps, on my quest to Mr. 5X all of things and get even more cash back. So anyways, guys, if you've liked this one, drop me a thumbs up down below. If you found it particularly interesting, consider subscribing to the channel. Again, posting content just like this every Monday, Wednesday, and Friday. Of course, right back here every Sunday with all the news you can use in the week that wasn't credit and finance. Again, my question for you guys is, let me know down below, what do you think of this? Do you already do it? Am I just late to the party? Love to get your thoughts on this, as well as some of your strategies if you're pro or con escrow. Love to get your thoughts. Anyways, guys, that's going to do it for this one. As always, thank you so much for watching. We'll talk to you very soon in the next one.